This is the current federal tax developments for the week of August, I should say, the 13th, 2018. Current federal tax developments, as always, is brought to you by Kaplan Professional Education and by your state society of CPAs. This week, we actually have big news happening this week. You might have heard the 199 Cap A proposed regulations came down, upon which we are told we can rely. We'll find out that we have some answers and then a whole bunch of questions. We'll also take a look at a couple of other developments this week. We'll talk about another state that came out with its Wayfair announcement about when it's going to start requiring out-of-state sellers to collect sales taxes. We'll talk about an S corporation that tried to get a deduction for legal fees that had been related to an investment made by the shareholders. And then we'll close out looking at a very, very quick overview of these 199 Cap A regulations. I want to warn you ahead of time before we get there, this is definitely the 40,000-foot view. These regulations are long, they are involved. There's a lot of special cases in there, and there's things we just won't be able to cover here today because we don't like these to run very much over a half hour if we can avoid it. And so we're going to try to keep it a bit under control today, but understand that we will try to hit some of the highlights and maybe at least get you some ideas of the things you should be looking at in the 180 plus pages of regulations that came down this week. Well, let's start not with those regs, but let's talk about another state chiming in on its Wayfair position. In this case, we're looking at the state of North Carolina. North Carolina Directive 18-6, that was issued on August the 7th. And what the state of North Carolina did this time was, much like other states that have been involved here, they've now set up a method to start collecting out-of-state sales tax. Those who are required to do so will need to begin collecting the tax and remitting it to the state of North Carolina on the later of November the 1st of 2018 or 60 days after they first meet the tests for requirements. The state of North Carolina, like a whole lot of other states, is going to borrow South Carolina's test. So as with South Carolina, a company has to file with the state of North Carolina if they have more than $100,000 in current year in what they expect to be current year sales or in the prior year sales. And they also have to, file if they have 200 or more individual transactions. One of the interesting things here is this is the first state we've seen that I've noticed that has a November 1st start date. That's an odd start date. We've seen July 1st, we've seen October 1st a whole lot, and we've seen January 1st on a few states. Now the state of North Carolina, for various reasons, has picked November 1st. North Carolina is a streamlined sales and use tax state. Therefore, you can sign up with the streamlined sales and use tax site. You can get all the SSUTA states there, or North Carolina provides you with information basically on their announcement about how you can go to their own website and set this up. Okay. Now, the other thing that happened this week that is not the regs is we have a case. And this case involves an S corporation. The case is the case of Garcia versus Commissioner. It is tax court summary opinion, in this case, 2018-38. It came out on August the 7th. And the Garcia case involved a taxpayer who had a bit of a problem. Well, he had invested in, it turns out, an investment that, well, it was a bit of a scam. And that, of course, isn't really something good. You'd prefer not to be in a bit of a scam. But Mr. Garcia and his wife had invested in what was essentially a scam program with an investment in South Africa. Now, as part of this investment, then they decided we want some of our money back. So the minority shareholders in this organization started a legal action in South Africa, and the Garcias became part of the consortium, and they agreed to advance up to $500,000 worth of legal fees, worth of expenses to cover the legal fees for this South African litigation. Now, of course, that's kind of a problem because that, as being investment expenses, They had bought stock in a corporation. They're now suing to try to recover the money that they had paid there. They claim they lost because of this scam. That's going to be a miscellaneous itemized deduction because it's going to be a 212 expense. And it's going to be subject to the 2% of AGI limitations for the years they were looking at here. For 2018, it's even going to be worse. That'll be totally non-deductible. Well, the Garcias didn't like that. And by the way, it's also non-deductible for AMT purposes in years prior to 18. Obviously, in 18, not deductible for anything. So the Garcias said, here's what we're going to do. We're going to form an S corporation. This S corporation, they put a number of rental properties in, and then they contributed the rights that they had under this litigation to the S corporation. Now, they claim this put the S corporation in the trade or business of funding legal disputes. Interesting concept. And based on that, they tried to claim the amounts they were advancing to the council in South Africa as legal expenses that were 162 trade or businesses front page of the return and deducted on their individual return on Schedule E, used to calculate their AGI. IRS said, guys, okay, we agree you have legal expenses, but these expenses are truly not related to any trade or business. The year in question, they had paid three times. They issued funds. They issued money in to pay to the consortium to handle their share of legal fees. 2 of those came from the Garcia's personal accounts. 1 of them came from the S corporation's accounts. Well, the tax court kind of took a look at this. And they said, okay, here's some of the problems that we've got. And basically, none of this is going to work. The 2 payments that were made by them personally, the court said, here's your problem. In order for there to be a deduction for the S corporation, the S corporation it's got to be the S corporation's expenses, and the corporation needs to pay it. For the first 2 payments, neither of those were met. That is, the S corporation did not make the payments. In fact, one of them, actually, the payment occurred before the S corporation was actually formed. So they've got one before the corporation is formed. That could not be a corporate expense. They had a second one that wasn't paid by the corp. Okay, that's not going to be a corporate expense. Now, they did have a third one where the check did come from the S corp. But the problem on that one was that the the tax court said, look, there's no evidence that the S corporation really stepped in and now became the litigant in this case. They said very simply, they never notified the court in South Africa they were the litigant. They never notified them. All the checks, all the letters and everything came back to the Garcias personally. They also said, look, it's still not really, there is no trade or business of funding legal expenses. Rather, let's call this for what it is. It's an attempt by you to get what would be considered 212 expenses deductible below the line. You're trying to find some way to move them above. Why that's important here is because this year, the incentive for clients to try to do anything to move expenses above the line increased dramatically. Anything that goes on Schedule A, that used to go on Schedule A, miscellaneous itemized deductions subject to a 2% haircut, is now gone. Don't be surprised if your clients come to you with all kinds of neat theories about how they should be able to form an S corp and suddenly be able to deduct these legal fees. Garcia's case is a pretty good reminder that this doesn't always work so well. Okay, let's go ahead and try to take some time here to look at the proposed regulations that came down on 199 Cap A. This is Reg 107892-18. The IRS released it on August the 8th of 2018. It is set to be published in the Federal Register next week. Now, these regulations, they are proposed regulations that we have been waiting for virtually since this law passed, because there are a whole bunch of questions that we need answered on this whole area of the 199 Cap A deductions. Okay. Now, the good news is the IRS released these with the language that taxpayers may rely on these regulations until final regulations are issued. That's good news for a couple of issues, because A, it means that we actually have something we can work with. And secondly, to be totally honest, it tends to make it more difficult for the IRS to make taxpayer unfriendly changes to the regs. Because if we've been told we can rely upon these, then they end up with this problem of having to let something go for the first year and then undo it the next. And then if it's something that had some actions on it, then we need to somehow figure out how to let the taxpayer, make this change, how to let the taxpayer get the stuff transferred over, so that they can get back and go ahead and keep doing what they've been doing, to get back to where they were, because we changed the regs. Because of those complications, most often the IRS is going to be less apt to want to make a change that's going to have a problem in that area. Now, one thing I'm going to tell you, what I'm going to give you right now is very, 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 very much a summary. Okay? Be sure to check first the printed materials. Our printout for this week is much longer. You're going to find out that we have 91 pages in the PDF that we post with this broadcast on the Current Federal Tax Development site. We also are going to be posting a write-up standalone, which will be the same material basically, but a standalone write-up of the 199 Cap A regs, which will also be up by the time you listen to this on Monday. Read those documents and go get the actual proposed regs. This is a very complex area. There's a lot to be looked at, and we're not going to be able to cover it in the time we have remaining in today's session. That simply is not going to go. Now, these regulations break into various topics. We got for operational rules are covered. That's what the IRS calls essentially the basic mechanics of calculating the amount, including for those below and above the threshold amount. Now, in that section, they actually do tell us one interesting thing, though. It has definitions. And one of the things they do, there's in that definition of trade or business, they do allow us to treat a rental that doesn't rise to the level of a trade or business, but where we are leasing the property to a trade or business, that basically that we happen to control, we can treat that rental as a trade or business. So that's probably, that's a good thing. It's basically the equivalent of what we got under the net investment income regulations. You remember those? We got that whole session there where we were able there to treat that rental as not being net investment income. Similar relief here, which is good news. We have some guidance there on W-2 wages for those limitations here, and the basically the unadjusted basis at original acquisition of property, of qualified property. That'll be involved. We'll have that issue. We have discussions there. We have some discussions of what is and is not qualified business income. We also have discussions here of qualified REIT and qualified PTP income. We have a very important sections on how we can aggregate items. In essence, what's required for us to be able to aggregate what might be, a business that's spread across a couple of entities. How can we do that aggregation? That'll be a significant issue. We have a discussion here about what is a specified service, trade, or business. We have definitions of each of the types, and we have some other rules related to it. We have a whole discussion of the trade or business of performing services as an employee, including a rule that's meant specifically to keep people who have been employees from magically becoming independent contractors this year to get to 20%. Yes, believe it or not, the IRS thought of that and went after it. We have various special computational reporting rules for this thing called an RPT. We got new acronyms. RPT essentially talks about what's going to be, in this case, S corporations and partnerships. In essence, it's basically, in this case, the RPT definition is for, as I get my right term together, or RPE, not RPT, is a relevant pass-through entity. So that's relevant pass-through entity, RPE. All that means is it's an S corporation or partnership is basically what we mean. To some limited extent, it can be a trust or estate, which brings us to a regulation. It's going to be on computational reporting rules for publicly traded partnerships. They have special rules too. And trust and estate issues. Okay, how those go with that 199 Cap A, and also a not 199 Cap A reg, but the IRS is going to put in a special rule that will allow them to combine multiple trusts that seem to have been formed solely to save income taxes. There are proposals to use them here. But by the way, this reg will also cover those proposals you've heard from people who say, well, we could set up like 20 trusts and spread our real estate taxes out over those 20 trusts so the 10 grand limitation doesn't bother us. IRS says, guys, we're planning to shut that down. So you do need to review that reg if you have somebody talking about that. So let's talk about some of the key issues here. First, on operational rules, what we start out with there is the definitions. And one of the key, trader business means a trader business under 162. Now, they don't tell us much about how to identify one. And what's going to be more important, how do we tell if a person or an entity is conducting more than one trader business? And that may be very important. But what they do tell us in this definition is that self-rental rule I mentioned. So in essence, because of the self-rental rule, if we rent or license property to a trader business that's commonly controlled, the rental and the trader business are under common control. If that's true, then the rental becomes a trader business as well, kind of linked to the thing it's leasing to. That can be good news because if we're making money on that on a triple net lease, which we probably are, then we're going to be able to get the 20% against that, assuming that we don't have a problem with this being a specified service trader business that's going to cause us other issues. We have discussions in there about the special rules for, calculations first they give us for those who are below the threshold amount. And they broke into two different parts. So they have one section just says we're going to ignore all these phase outs and SSTBs and, and the whole issue of W-2 limitations. We're just going to do it for those below the limits. And then it's relatively simple. They have a section there telling you in that simple case how you compute a loss carryover. Remember, we have separate loss carryovers for purposes of computing the 199 Cap A deduction and for purposes of computing our regular income tax. So if we have a net loss from trader business, net negative QBI for the year, we're going to carry that loss into the following year, but only for computing QBI. It's not going to affect taxable income otherwise. So that's a key issue. It tells us about how you're going to deal with that. They also tell us about calculation for those above the threshold. In that area, they talk to us about the fact that we're going to first do, if there's any specified service trader business, we first apply the percentage there. So in essence, if you have an SSTB, we're halfway through the phase out amount, then you're going to treat it as 50% of everything. So it's going to be 50% of its revenue, 50% of its W-2 wages, 50% of everything else is going to come over because it's an SSTB. After that, we'll then do the W-2 limitation calculation. And they remind us that is a per trader business limitation. So even though you may have 10 trades or businesses, each one has to separately be tested on the W-2. The SSTB limitation, of course, it also is separate for each trader business. So you have to remember these two limitations, we look at each trader business separately. For the SSTB, determine if it is a specified service trader business. For the W-2 and qualified property limitation, we look at the separate trader business for purposes of saying we can't have any more deduction allocable to this than the limitation allows us to have a deduction. Okay. We also are told an interesting side effect, which makes sense. But in the first regulation, they tell us that there is no effect on basis for your S corporation stock or your partnership interest. That makes sense if you think about it, but I'm sure some people might be a little surprised. So the S corporation passes out $100,000 worth of income. You get to take your $20,000 deduction. You're going to basically, that particular deduction, the $100,000 will increase your basis. The $20,000 will not reduce it. So for that year, your basis would go up by $100,000 if you had no distributions. But your basis, so it won't be netted. It won't just go up by 80. So that's generally good news, I guess. And in one sense, not surprising. But as I said, some people might not have thought that was going to work that way. Now, we have a special set of things there for W-2 wages as well. Okay. Now, this section is not talking about whether somebody's an employee for purposes of the fact they can't claim the deduction. The W-2 wages section here is really talking about it, determining how do we determine the W-2 wages that are allocable to our trader business. So we're looking at these rules as to how do we get them allocable to trader business. They define those Basically, they're kind of what you expect. And they also tell us we're going to get methods to come up with a number. We'll talk about those in just a second. There's a key clarification in here. PEO and leased employees, they count a lot. Some payroll services had been freaking out over this, worrying that the IRS was going to say that if you use a payroll service, you couldn't claim this half deduction. Some people were concerned. IRS, pretty much as expected, they followed the same guidance they had in the 199 regulations. They said flat out, nope, don't worry about that. As long as they basically are really your employees, but they just show up on somebody else's W-2, we're fine. Now, they do have to be really your employees. So I would say that probably means when you read this reg, that if, as some people pull off from time to time, they set up an employee leasing arrangement, but it's a partnership, and they end up putting the partners on the payroll. Those partners will not qualify as your common law employees. So those wages would not be W-2 wages. In fact, those wages almost certainly are going to be guaranteed payments. So it's going to kind of, by the way, you won't get the deduction for guaranteed payments either. That's part of the qualified business income. That's not part of your qualified business income deduction. Now, to be able to use your W-2s, though, in this calculation, they must be filed with the Social Security Administration no more than 60 days late. So if for whatever reason you don't get the W-2 filed, or you treat them as 1099 employees, and then suddenly, the client's told, hey, wait, these are all 1099, not 1099 employees, 1099 miscellaneous non-employees, and suddenly the client realizes, uh-oh, I can't claim the deduction, I should have treated them as employees. That's not going to work. You got 60 days to get it fixed. The IRS did, at the same time as the proposed regs came out, they issued a proposed revenue ruling. Notice 2018-64 for calculating W-2 wages. They give you 3 methods to do it. And the first one is labeled the unmodified box method. Just takes numbers off the front of the W-2. We have a modified box 1 method, okay, which takes numbers and makes some modifications to taxable income, and what's called a tracking wages method. You want to take a look at the proposed revenue procedure. And by the way, the notice tells us we can rely on this procedure until it's actually finalized. So you want to take a look at those options, because you will pick one of those. Once you pick one, you have to use it consistently. So there are some rules involved there. We can't just, we can't use unmodified box method this year and then the tracking wages method next year. You have to pick the one you're going to be using, so you want to take a look at that. Also, take a look at the revenue procedure. There are special rules if employees are transferred, or like we incorporate a business during the year. There are some special rules. In most cases, for any year like that, you're going to use the tracking wages method for that year, is what the IRS tells us. They also give us some information and guidance, and this is a little more complicated area, for basically unadjusted basis immediately after acquisition of qualified property, or what they call UBIA. Okay. So now they first tell us what is and what is not qualified property. Remember, to use this, it's got to be, as we say, qualified property. Now, qualified property has to, of course, be held by or available for use in the trade or business as of close of taxable year. So you have to have it there the last day. That's one key thing to remember. It has to be actually used at some point during the year in the business. And the depreciable period has not ended before the end of your individual or RPE's taxable year. Now, the depreciable period has a special meaning. You might think, well, it's just depreciable life. No. The depreciable period is the time period that starts on the day you put the equipment in service, and then ends on the day 10 years after you do that, or if later, the last day of the last full year in which the applicable recovery period would apply to the property under standard makers, right? Regardless of any elections for ADS. So if you have, let's say, 15-year property, then it is going to remain qualified property for 15 years. But if you have 5-year property, even though you'll be fully depreciated before the 10 years are up, it will still be qualified property for this purpose for 10 years. So minimum of 10 years, but we can go out further. So in essence, a commercial building goes out 39 years as qualified property. The IRS did clarify that any 734 and 743 adjustments with a partnership, that's where you have a 74 election in place, and either you redeem a partner who, like you redeem a partner who left, there are other transactions that trigger 34, but that's the normal one. Or somebody buys a partnership interest, somebody inherits a partnership interest, those are not qualified property. Now, remember last week we talked about the depreciation rules. 743 property that wasn't inherited, that did count for bonus. That's great, but it's not going to be qualified property. So the partner does not get qualified property. If when they buy their interest, they don't suddenly convert that adjustment into additional qualified property that would run 10 years. My guess is the service thought that doesn't make sense. Why should the increase in value run 10 years, but the basis that was there when you came in would only run for its remaining life? So for whatever reason, whether you like it or not, that's kind of how they did it. They also gave us special rules for like-kind exchange and involuntary conversions. Basically, if you remember the standard rules we have for these, if we don't elect otherwise, we end up with dual basis property. That is, for instance, let's say we have involuntary conversion. To the extent we're deferring gain, we're going to keep depreciating the old property on the books, defer the gain. But then if we pay in excess of what we had to in order to defer the gain, that additional cost becomes a brand new asset. In that case, you're going to have two separate pieces of qualified property. And the original property, the property that's been relinquished because it burned down or because you exchanged it, that's going to run out of life the same time it would have had you kept the old property. But any extra that you pay, that's going to go ahead and run starting with a brand new life in the year in which you pay the money, you put it in service, the new property in service. So that one's going to run for a longer period. Unless, if you elect, which you can do, you don't have to use that double basis method for makers. You can elect, if you wish, to treat it as one single asset for the total, the adjusted basis of what you gave up plus any boot or other cash you put in. If you use that, then it is treated as a brand new piece of property placed in service, and it starts a 10-year period, or basically restarts the depreciable life on the whole thing. And so, as I say, you end up restarting it. Whatever you elect for makers controls this. So you have to understand, if you elect to treat it as one, then you're going to have a brand new asset, and you're going to run the entire basis for the longer period. But remember, here's your problem. You're giving up, though, the unadjusted basis of the other property, because you're going to get the net basis added to that total, but you're going to have a full unadjusted basis on the relinquished property if you use dual. So this is kind of an interesting mess which way that goes. They also give us special rules when we have various tax-free exchanges. In this case, we're going to talk about transactions, for instance, that do things like, incorporation under 351. You contributed to let's say, a partnership under 721. You have a corporate reorganization. We have a 332 liquidation of a subsidiary. In those transactions, basically, we're just going to step in the shoes of the old holder of the property, because we're going to get carried over basis in those cases for the most part. So we're just going to step in. So if we're halfway through the depreciable life, we're halfway through the depreciable life. We don't get to start a brand new one in those situations, right? So all of these things come up with this issue. The basis we use is generally the standard basis rules for how we determine basis of property, also certain additions to property. The one exception is if you reduce basis because you take a credit, that basis reduction for taking a credit does not apply for purposes of computing this unadjusted basis immediately after acquisition. If that computation uses the higher number. Now, again, this whole basis thing in property only matters if we're using the 25% of wages plus 2.5% of UBIA of qualified property for, to calculate, and it actually does limit are the amount of 199 Cap A deduction we can claim for a trade or business. If we're not, if we have tons of W-2 wages, this whole thing may not matter. So just keep that in mind. Okay. As we keep moving on the way with all of these neat little things here. So, that's one level of complication, liking our complications. So we go from there. Now we have a couple of other issues coming up here, right? As we said, and I should say one other thing they have here, I've got to mention this. There is a really weird issue if I have to allocate for an RPE, that's for an S corporation or partnership. If you have any assets that are currently still generating depreciation expense, you allocate their UBIA based on the amount of depreciation allocated to each partner. However, if you have property for which we have ceased depreciation because it's fully depreciated, then what you have to do is figure out how would we allocate a gain, considering both 704B and 704C rules if the property was sold this year. So you have two allocations, one for property that is currently being depreciated. You allocate their UBIA based on depreciation. And then the second one for properties fully depreciated. If there's 704C items in there, this could get interesting depending upon how much the property is deemed to be worth. You could find that you suddenly this year decide, well, it went up in value. So now we've exceeded our 704C difference when it came in. And so in that case, now we're going to change it based on that. Or maybe previously it was worth more. And so because of that, we had 704C, and then we got outside of that and still had our B allocation because we weren't allocating contributing partner anymore, but we were only there, but we were able to allocate the gain to the other partners. Now suddenly we have that change as well. So this is going to be interesting because you have to figure out how much each year those fully depreciated pieces of property are worth and determine how the gain to be allocated. And as I say, that's interesting if you have any C property in the mix, right? If you haven't taken, by the way, if you're doing a partnership return, hopefully you know what C property is, because C property would call you into a problem. Next up, we have other issues. 1231 gains and losses cause us neat problems. And the way this works is not really straightforward, but it's what we've got. So this is on qualified business income. 1231 gains and losses, to the extent a 1231 gain or loss is taxed as capital, it does not count as part of QBI. Now remember, we add up, we net our 1231 gains and losses. If we have a net 1231 gain and we're not subject to the recapture rule due to recognizing losses in the prior 5 years, that gain is taxed as capital. In that case, that gain would not be part of QBI. But if we lose money, net loss, that's considered to be a 1231 loss, which is considered to reduce our QBI income. Now and then to top that off, if we had a loss last year of 100 grand, this year we have a net gain of 50. Well, that gain of 50 due to the recapture rules, tax is ordinary. And then there's the question of, what about the netted amounts? What about, I have a $100,000 gain in this business, I have a $200,000 loss in another. Now, was that 100,000 gain really taxed as capital? Probably not. But flip that over. I've got a $100,000 loss and I've got a $200,000 gain. Is that $100,000 loss still considered taxed as ordinary, even though it nets out and our net 1231 gain is capital? Reg's not totally clear on that. So just watch the 1231s. They're a little bit interesting. The IRS also talks to us about reasonable compensation and how that, remember, we don't count reasonable compensation. The IRS makes it very clear reasonable compensation is solely an S corporation issue. They are not expanding this to partnerships or proprietorships. They had suggested they wouldn't do that. Now they said for sure they won't. But they also said those of you who thought maybe we could add back S wages to the S corporation pass-through income, they make it very clear that that doesn't work. That's not going to happen. They also talk to us about guaranteed payments. If a guaranteed payment is made to a non-individual, that retains its basis. So if you've got a partnership, an S corporation owns an interest in a partnership, the S corporation receives an allocation of guaranteed payment. That's not going to magically convert into qualified business income when it flows through the S shareholder. Rather, that, let's say, $10,000 guaranteed payment at the S level is going to still be not QBI when it flows out, that flows out to the individual partner. So it retains it at that point. We have a couple of other issues here. The IRS just said any 707A payment is not QBI. The regs allowed them to pick and choose. They do ask for comments about whether they should change this, but right now, any 707A payment will not be QBI. A hot asset gain or loss, those can be QBI. If they relate to a trade or business, they're qualified business income. So the hot asset gain will qualify for it. They also tell us some things we're going to test for whether they occurred before or after. For instance, if there's a 41A adjustment, any of those that occurred before 12/31, before basically 2018, those are going to be considered to be not part of QBI. But a 41A adjustment that occurs after that date will be part of QBI that arises after that date. Similarly, if you have passive loss carryovers due to basis, those before the effective date are not entered into QBI calculations. Those that are triggered, that basically are after, like, you have a disallowed loss in 18 due to basis, but you pick it up in 19, those are considered to be part of QBI. So that's a complication for us. We also have a special issue with the net operating loss rules. Net operating losses don't count toward QBI with one exception. If you trigger the excess business loss rule, remember you can't have more than $250,000 of business losses on individual return, $500,000 in married filing joint. If you're in excess of that, we disallow the excess and treat it as a loss carryover. Only that carryover, which is treated like it's an NOL, only that portion of an NOL will enter into your QBI calculation in the future. And they also have rules there about requiring a reasonable allocation among directly conducted trades or businesses. If you have more than one trade or business in the S corp, you must reasonably allocate all the items, wages, UBIA, and the income. You have to also do that among each trade or business. If you're an individual, you're conducting your own trade or business, you have to do a reasonable allocation. But it has to be directly conducted by the entity or the person. That's key in the regs. Now, here we have the aggregation rules. Those were kind of big. A lot of people were very interested in how the aggregation rules would come down. So let's talk briefly about those. The aggregation rules allow you, the IRS said generally you can't combine. If it's different entities, then you're not allowed to combine them into the same trade or business. However, the IRS did say you can aggregate if you meet 4 conditions. First, you have to meet 4 conditions. So before you consider if you can aggregate, you got to meet these 4 conditions. The same person or group of persons must directly or indirectly own 50% or more of each trade or business to be aggregated. So you got to have 50% or more ownership, basically, directly or indirectly. The ownership must exist for majority of the taxable year in question. All items treated as trade or business to be aggregated or reported on returns with the same taxable year, not taking into account short years, and none of the trades or businesses is a specified service business. So you cannot aggregate SSTBs, is what they're saying. If you meet those criteria, now we go on to the next thing. Then you have to meet 2 of the following 3 additional conditions. So you basically, you can miss one of them. The trades or businesses must provide products and services that are the same or customarily offered together. That's condition 1. Condition 2, the trades or business must share facilities or share significant centralized business elements such as personnel, accounting, legal, manufacturing, purchasing, human resources, or information technology resources. And the third one is the trade or business are operated in coordination with or reliance upon one or more of the businesses in the aggregated group. For example, a supply chain interdependency. Now, you can miss one of those 2, but only one. You have to show 2 of those. So again, 4 mandatory conditions, and then 2 of these 3 other conditions must be met. If you meet those requirements, then you can aggregate. Now, if you aggregate them, you must report aggregations each year. Okay, every return's got to have an aggregation report on it. If it doesn't, the IRS can disaggregate. It's just automatic. They can do so, right? And you must, once you aggregate, you must do it consistently. So you have a report to go on every return, and you can't change it without basically having a significant change in circumstance. Aggregation is interesting. I've been watching a bit of discussion on Twitter. Normally, you're going to want to aggregate because the way this works, if you aggregate on the W-2 wages, remember, we have to test each business to see if it has adequate W-2 wages. So if I have excess W-2 wages in one business, I can't use that to free up a deduction to increase my deduction in another business that doesn't have enough W-2 wages. But if I can aggregate the two, I combine their W-2 wages and combine their income, then I really do get to use that excess. The only situation, and I was watching a thread on Twitter that went into this, would be a situation where potentially it could be a problem combining if one of them is going to depend on the W-2 wages test and the other one's going to depend on the property test to get the requirements. It is possible in that situation when you combine them, you could end up hurting yourself and losing some deductions. But in most cases, you're going to probably want to aggregate anything you can aggregate. But, take care and watch out, though, for that whipsaw condition. If, in fact, we do get into that where, you need to use different tests. But otherwise, probably going to want to combine. Specified service trader businesses, we have definitions for each of the categories. And the good news is they really narrowed these. They are extraordinarily narrow. Financial services, for instance, does not include banks. Banks are left off the list. Brokers, real estate brokers, mortgage brokers, those sorts of things, they're not considered brokerage services. They're not SSTBs. And they extremely narrowly define the reputation or skill category. In essence, it really comes down almost to just endorsements. If that's your business is endorsing products, then you've got reputation or skill business. But otherwise, it was not read broadly at all. That is really helpful because a lot of people are getting very worked up over that reputation or skill category. Turns out when you check and see how narrow this is, it's not that big a deal. Now, here's the catch though. But if you are operating, if your activities are part of this, then we've got issues. So the IRS says, well, you don't have to worry about doing some of these services and getting money for it, as long as if you're less than 25 million in revenue, less than 10% of your revenue comes from this, tainted service. Or if you're over 25 million, less than 5% comes from it. But interestingly enough, and there's also a debate going on, a Twitter debate I'm following on this one too, about whether or not, well, okay, let's say you have 30%. Does 30% taint the entire? 70% of your revenue is coming from things that aren't tainted. And I think the answer is if it's a single trader business, the whole thing's tainted, or at least theoretically. It is a de minimis rule. It is a safe harbor. So in theory, you can try to argue for the 70%er. But in reality, it appears the way agents think, it's going to be probably they're going to try to get you at that and say it's just going to taint the whole thing. 30% of service revenue would taint the whole thing. But here's the catch. If you can establish that the service business is one trader business and the other thing is another trader business, it clearly allows you to have separate trader businesses. The problem is we don't have a clear definition of under what conditions you can consider things separate trader businesses inside the same entity. So that's an interesting problem. Now you might think, wait, Kraken Pack was going to solve all this. No, they figured that one out. There are anti-Kraken Pack provisions. First thing is if you establish another entity and over 80% of its sales are to a SSB, so it has over 80% of its revenue, I should say. It says services on the slide I did, but it really was revenue. When 80% of its revenue comes from the specified service trader business, then that's going to be considered to be part of the specified service trader business. So for instance, some people were saying, oh, well, why don't we do this? We'll just create an administrative services company and we'll push out our admin people there. And then, we're going to pay a really high price for admin work. and we're going to make that income into, nah, not going to work. If you do have a business where you can get that number below 80%, you're still going to have to treat the percentage that is sold back to the SSTB as being part of SSTB business. Okay, so that's the structure. Now, that said, obviously, it suggests that crack and pack works if, in fact, there is nothing going back to the SSTB. But the question becomes, yeah, watch that carefully. I mean, it's still kind of weird how that goes down. A lot of debate about that de minimis rule versus the other issues. But the way I read it, de minimis rule, you will taint the entire trade or business if your percentage goes over, if it's all one trade or business. If you can establish it's multiple trades or businesses, then we can start talking about then we can start like treating the stuff that is going for the non-SSTB business. That's fine. We get the deduction. The SSTB business, we don't. The IRS also puts in rules about employees. Remember, if you're getting money as an employee, you cannot treat that. They're concerned here about people who are being 1099 who really are employees. They are going to use the common law definition of employee. And remember, in this case, that question is going to come up on the individual taxpayer's return. Normally, we think about this as a payroll tax exam issue. They make it very clear, even if the employer doesn't have a payroll tax exam been forced to move you, the IRS on your exam can still move you and say, nope, you're an employee. We're going to disallow the 20%. The IRS makes it very clear. We don't care what their 941 does or doesn't show. We don't care what the W-2s do or do not show. That's irrelevant. And as well, it provides, if you previously provided the similar services as an employee that you're now providing on a 1099, there's a presumption under the current law, under the law, that you basically are in a trade, let's say that you are providing services still as an employee, and we're going to disallow the deduction. There is a way to overcome the presumption, but to overcome the presumptions, you've got to be able to prove you're a common law employee. You're not a common law employee. You've got the entire burden of proving you don't meet that. So that's going to shut down what they're going to look for this year, which makes sense. People who were W-2 last year, but this year now have a 1099 from the same organization. This is a mess, as you could say. And we just barely touched the surface, and I went still way over what I'd want to for a normal weekly presentation. There's a lot more to be done. I am going to be doing 2 4-hour sessions, I want to remind people, especially those of you in Arizona and Idaho. Arizona, I'm going to be doing the session live and webcast. It's 4 hours. And I'll be doing that on August the 22nd. And that will be at noon Mountain Standard Time. And as we all know, we don't play with clocks here in Phoenix. So noon Mountain Standard Time, for most of the rest of the world, they would consider that Pacific Daylight Time. You think about that sound point. So, as that goes, the Idaho Society of CPAs, we will be doing a webinar on the 30th of August. That'll be at 9 a.m. Mountain Daylight Time, 8 a.m. Pacific Daylight Time, depending on which part of Idaho you're in. There's your start times. That one will be a webinar. Registrations are open for both of them right now. So as I say, I think it's going to be important for everybody, here in the next month or so, to get some sort of deep dive on this. In fact, the best thing I think you can do is get the regs, take a look at them. This is important enough. I know you hate to read regs, but this is important enough and means enough to your clients that I think you have to take the time out and look at these, and then get together with others in let's say, a session, get together in a discussion group, find somewhere to get together, be it a course like this, be it taking webinars, but get some other people's input on how to read these things, because these regs are very, very, very involved. There's a lot of nuances, and it's one of those things, the more you look at them, the more you find new things that you begin to wonder how they really work. So, do something on that. But again, we've got Arizona and Idaho societies going to be doing 4-hour sessions on the 22nd and on the 30th. So if you can, like to see you sign up there. You can go to those societies' websites. They've got them. Also, consider there's lots of things going on in this realm. And the good news is a lot of state societies had booked various TCJA courses for August. So all of the instructors are all going batty, as I am. trying to get all this stuff together. But take a look at sign up for your state society. Most state societies are offering things on the Tax Cuts and Jobs Act, and obviously these 199 Cap A regs are going to be a big part of that. Be sure you check and sign up for those courses. In addition to the ones I'm going to be doing for 4 hours, I'm going to be doing a set of, I'm going to be doing 2 8-hour courses on Tax Cuts and Jobs Acts for business over in general, one in Boise, one in Phoenix. And then I'm going to do my standard current federal tax development sessions in Tucson and Phoenix late in the year. Those will also cover these rules. You need to get yourself someplace to actually just talk this out and talk with other people. This is complicated and it's really radical change in many ways. Get yourself some preparation for this. This has been the current federal tax developments here for the week of August the 13th. You can follow our updates at currentfederaltaxdevelopments.com, where we'll post things up on that site. If you have any questions or comments, you can send them to me, Ed Zollers at currentfederaltaxdevelopments.com. I do look in on Twitter at Ed Zollers, is where you'll find me there. Also follow discussions on the subreddit of reddit.com/r/taxpros. I follow discussions on the Tax Talk site for California, the Arizona Society's listserv on what they call their Connect website, also New Jersey's Connect website, same thing. So I do follow discussions there. If you have access to any of those, by the way, the Tax Talk one, regardless of where you're a member, if you're a CPA or attorney in any state, you can sign up for the Tax Talk it's a Yahoo group. It is technically a California Society of CPAs run organization, but any CPA and any attorney in the country can qualify to get in. So you might want to take a look there too. Those are going to be incredibly useful for this whole 199 Cap A. With that, I don't know if the IRS is going to give us any other big regs in the next couple of weeks. At some point, we're going to be waiting to figure out, the entertainment problem will be coming. The whole state and local tax workaround reg that they're promising us. So those are to come. But right now, we got more than enough to digest. So be sure, take care. Have a good week, hopefully. And we'll see you here next week for what will hopefully be back to a regular half-hour version of current federal tax developments.